Hi, everybody. Welcome back. We are here for another one of your questions about work. And for those of you who are here for the first time, I'm Roy. I'm a startup investor in the future of work. We sometimes focus on questions that are relevant to people starting companies, although I also think anybody building anything can think about these questions. And this one is rare because we're going to be talking about not like your usual, like, should I be building a venture capital company in the way that I read about in the press? Because we're here with Einar Vollset, who is the founder of several things, including a fund that we've had the privilege to invest in called TinySeed. He's a partner of TinySeed. TinySeed focuses on investing in businesses that the rest of the capital market doesn't have good ways to support. I'll let him describe that a little bit, oftentimes bootstrapped founders. And so, Einar, the question that we've got today is, I'm a founder, I started something, I'm considering bringing on money, but I've heard that investors could be bad, could ruin my company, et cetera. Is that right? Should I be scared of taking on money?
Yes, you should be scared of taking on money. No, I'm only kidding.
I think people should fear it. I tell them the only reason to take VC is because you have no other choice, and you got to do it carefully.
That's true. I think that's true. I think one of the key things to understand is like, you need to understand the incentives of what the investors that you're taking money from, because they can vary very greatly. So if you're taking, so people know like where my framing is. TinySeed, we basically invest in B2B SaaS companies, capital efficient, early stage companies that are typically not necessarily on the venture track. So we're looking to basically back founders who have something going, whether that's full-time or part-time, doing 2,000-3,000 MRR, to 15, 20, and want to grow that and sell it for 10 million or 50 million or 100 million or something like that, but not necessarily be like, oh, I need to be Mark Zuckerberg. Now, that really like that understanding of where we come from in terms of what kind of investing we do should inform what you think we will do and what our incentives are with your company. So for us, if someone comes along and we invest and then they go along and they get an offer for, let's say, $30 million from a private equity firm that wants to buy it, then we're stoked. Like we're excited for you, most likely. But if you're doing the same thing and you're dealing with a seed investor who invests at, say, YC Demo Day and just put money in at 25 million pre, they're not going to be excited. And in some cases, and perhaps most cases, they will block that transaction. So while that might be sort of generational wealth for you and seem like an obvious sort of slam dunk, for them, that's just not a win. They would rather, you have a smaller, tiny chance of becoming a really big sort of outcome, because that's how that game is played for them.
And so, what I'm hearing you say, which I totally agree with, is that one way to avoid the obligation is just to ensure that the incentives that the firm that is investing in you have and your incentives are aligned.
Correct.
And so there's this obvious thing where it's like, the way I put it is, if you're a demo day company, the aspiration of most people who invest in you is that you have a chance, just a chance, but a chance to be one of the greatest companies in the history of capitalism financially.
Correct.
Like that is literally what they're trying to do.
Yeah.
And so if you don't want to sign up for that, or then it's worth knowing that. And at the same time, and by the way, I should just say, I feel I need to throw it clear on this, which is for our firm, we're very happy if we invest and there's no other round after us and we get a multiple on our money. We just need the risk to be, we just need to be compensated for the risk, which is to say, if you're shooting for a smaller outcome, then the price might be lower, for example, something like that. But practice,
I think founders basically too, like they're delusional about it sometimes too. And I think, particularly now,
yes.
I did YC, so I can pick on them, right? I love YC founders. It's amazing. But the fact of the matter is, I talk to alumni and, a lot of them just come out and say, yeah, we fibbed about, what our big vision was, because we knew we were never going to get into YC unless we said we want to take over the world.
Well, I think that there's a lying part. Lying it makes it sound so morally loaded. It is lying, but there's a saying what you think the investor wants to hear, even when you're unsure about it, kind of a thing. And then the other thing I just say is, one of the oddities of this is founders evolve over time. I've seen tons of founders who had a certain vision that was more modest, and they became more world conquering with time. I mean, I
Right.
remember Mark Zuckerberg saying, there's something powerful about us just being focused on college. And when Facebook was a .edu college focused thing.
Sure.
And so these things do evolve with time. What are some of the, are there other ways that, that the incentives can go out of whack?
Yeah, I mean, and like, to be honest with you, we see that too, and that's actually one of our largest challenges, because like we back bootstrap companies, and obviously, founders that come along, if they get a $5 million offer, that's still, it's $5 million. That's a lot of money. And I think a fair few founders, the trick for us is like, we know that when founders get into it and they have something that's working, that's exciting and stuff, they may very well evolve their outlook on, what success looks like. I know several founders who only afterwards, but like, tell me, when I got into TinySeed, if I could sell for $5 million, I would do that. And now they're in a stage where like, yeah, they could run an M&A process and sell for 5 million, but they're like, no, I want to get to 20 at least, or 50 or 100.
Yeah, I
So
mean,
that definitely grows.
What can a founder do about that? I mean, one of my things on this, and I'll just offer a thought before I would love to hear yours, is that you can have honest conversation with an investor about how you think about your financial life. And I think that can be hard, because a lot of investors, there is risk in that conversation. Like, a lot of investors might be like, oh, like I had an investor tell me like founders should never take secondary, meaning like they should never take any money off the table. And I was like, that's just crazy. Like, you work in a company for 10 years, you should just like keep making, and it's wildly successful. Like, you shouldn't get to participate in that. That just seems nuts to me. But you need to have a conversation about things like, well, I've got a mortgage, or I just had another kid, or whatever your reasons in life. I got to care for my ailing aunt. So one thing you can do is honest conversation. I'm curious, what else?
So for us, like, I think honest conversation, I think honestly, if you're going for the highest possible valuation, which seems to be the sort of public, this is what being a founder is, like higher valuation is better, then having an honest conversation about secondary when you're pre-product, pre-revenue, and being like, hey, by the way, I soon want to take $500,000 or $1 million off the table. Like,
yeah, not at that moment is not what I mean.
No. But like, there's definitely a trade-off there. I think be sensitive to valuation. Like, I think understanding how your investors make money is one of the key things to really understand. Like, this is true whether you're taking venture money or selling to private equity and minority growth, or whether you're talking to a debt fund. Like, you really have to understand that, because, for example, if you're talking to like the debt fund, like, Pipe or Lighter Capital or whatever, you have to understand how they work. And like, the fact is, a debt provider will, if it means they are more likely to get their money back at 3x, then they will do things that will hurt your chances of becoming a big company, because that's their incentive.
And I think that one of the major ways that this can fall apart is that is when founders receive an offer for something that's really appealing to them, but the investor wants them to keep going. And secondary can be one good solution for that. The other thing I just say in general about being scared, and look, as a founder, I had tricky relationships with some of the investors in our company, difficult and outright hostile relationships with others, and good relationships with others. And one of the factors that I didn't fully realize that we encourage founders to think about is, in addition to the financial incentives and how they make money, which, by the way, aside, that many VC firms, the way they make money is by raising money, which is why they want you to raise another round so they can just have a mark. But that's a whole other conversation.
You mark up my company, I'll mark up your company.
Yeah, exactly. All that. But one of the things I was going to say is that one of the things that happens is every single person that you let invest in your company, I describe as having the red button, which is to say, if you want to sell your company, no matter what the documents say, the acquirer might say, we want a signature from every shareholder. And so literally every person who invests in your company, you are giving them the power to put their boot on your throat if they want to do it. And so diligence goes a long way. References. It's one reason why we generally advise founders to avoid taking money from somebody who just isn't known to other people who they know, because they just may behave unpredictably. And that's why I was so grateful when founders took our money in the beginning, because I was like, how do you know we're going to behave predictably? Now we've got, a decade of track record, but we didn't in the beginning. And so that's another thing that I think is part of the, part of the milieu.
Yeah, and I actually think like, and this is actually more and more as we seeing the companies, the companies are performing. We've invested in a lot of companies now. I don't know if you know, but we're more than 100 companies.
Oh, I read the updates.
Yeah, and so like we have companies that are getting to a certain stage, and I think one of the things that investors would really like, if they could, they'd pay good money for, is a crystal ball that would tell them, will this founder ignore all enticing offers and go all the way to IPO? I think that's true. And one of the things that I'm starting to think about, that we starting to think about as we see this, and we see founders get some level of success, is like, is there a way that we can design in a similar way that we feel like at the very earliest stages, we sort of figure out a way how to support founders who aren't necessarily on that track already? Is there a way to sort of build sort of a framework and infrastructure where it can fit founders who are like, obviously, if founders want to go all the way, that's great. But some founders maybe don't want to. Maybe secondary is part of it. Maybe they want to take some money off the table. Some people want to be CEOs for the longest time. But honestly, some great founders don't want to be CEOs. They realize, okay, what got me to 2 million or 3 million is not going to get me to 20 or 50 or 100. Like, actually, a great example of this is sort of friend of TinySeed. We actually did an event with him in Austin last week before. Jason Cohen just did a piece on this. And he basically did, with WP Engine, he basically realized, I don't want to run this thing. Like, I want to be like the chief innovation officer or whatever thing, and just find someone who's a professional CEO. And I think like a lot of that, particularly, for businesses like B2B SaaS, that may make a lot of sense, where it's like, okay, maybe you get to a certain stage, and depending on what the founder wants to do, maybe there isn't sort of shame in taking some secondary, bringing in some support to really, for people who've been there, done that, and go from like, 5 to 50 million or whatever it is that they want to do. So yeah, that's actually something that we're actively exploring at the moment.
I mean, look, one way in which I've felt like TinySeed and Bluebird Beta are aligned is we both care a lot about trying to deeply understand what the founder really wants, and try to design a system that serves at least some set of founders and what they need. And the other thing you're just describing is that some of that may evolve over time, and it may be on multiple dimensions: what they want professionally, what they want financially, what they want emotionally, what they want geographically, depending on where the company is, and also sometimes business model. I mean, I've seen plenty of cases where a founder convinces themselves that, I should really do this business as an enterprise sales business. And then they start building and they're like, I actually don't really want to run an enterprise sales business. That's not what I had on my dance card, which fair enough, this is a process of discovery. All right. Any parting thoughts?
And it might be that it's like, I think actually one of the things that you'll find is like getting to that first level of success. It's hard enough. And people think, I'll just keep doing whatever is currently working in order to get there. Actually, a lot of the time, what you end up having to do is like layer different new things, whether you need to go for a new market, a new product, a new sales channel, a new whole thing. And it might be, for example, that as a SaaS founder, you're perfectly happy with a product that got you to $1 million or $2 million or whatever level of success with self-serve, with credit card. But now you need to add, in order to double that or 10x it, you now need to add in like enterprise sales. And then maybe that's not what you want to do or what you think you're good at.
No, I think that's right. And, and I just say that I think this philosophy actually generalizes beyond investors to anybody who's in a position where they have to partner with other parties, where what you're really saying is deeply understand what your other party wants and what you want. And, as a founder, I thought, what my investors want is to make money. They want to invest and make more money. And it's like, okay, yes, that's true, but they may want it with a particular risk profile in a particular way. With particular
like
timing,
in a very scalable manner. Like I'm finding that with fundraising for our funds, I'm like, it never occurred to me that people would be interested in our fund but not invest because we couldn't take enough money. Like that notion was brand new information to me. But it's like I was talking to somebody. I was in New York, like I guess a couple of months ago, and I was talking to somebody at some pension fund, and I was explaining what we're doing. He's like, "That's very interesting." And he's like, "But I'm
call me when you have 3 more zeros."
Yeah, our minimum investment is 250 million, and we don't want to be more than 10% of the fund. I was like,
you're like, okay, I literally need another comma.
Divide that up and like give me some.
Totally. Well, I mean, I think that's part of the modern tragedy of capital. In addition to the fact that it is distributed a little too much by guys who look like you and me, or a lot too much by guys who look like you. I know you like it, but I think
they should look exactly like me. It should be
the
me.
Mustache. With the mustache.
I think it should be me.
You can distribute all the capital if you wish, but then you'd have to dole it out to other people. Is that many founders need modest amounts of money, and distributing modest amounts of money at scale is something we don't know how to do.
Correct.
Yeah. So I hope you figure it out. And for folks who are watching this for the first time, maybe learning about TinySeed, but also just thinking about capital, I'll just say the reason we say this is not advice is neither Einar nor I knows what you should do in your situation. We're sharing our experiences, and you make your own choices. Thank you, Einar.
Amen.
All right. If anybody wants to find past episodes, you can always go and look at thisisnotadvice.work. And you can find the past episodes there. If you prefer short form audio, jam.ai and look for it. And Einar, we'll catch up with you soon.
Sounds good, man. Good to see you.
To be continued. Yeah, that was great.